Investing isn't a race. You need earned income to live, but you need portfolio and passive income to truly build wealth and achieve financial freedom. These 7 foundational rules that can change your entire approach. The very first rule, and perhaps the most crucial, is ever felt that knot of anxiety in the stomach when you hear people talking about investing? Like everyone else is on some secret financial highway and you are stuck on a dirt road just trying to figure out which way is north. You are not alone. Many young professionals just like you feel overwhelmed by the sheer complexity of it all. We compare ourselves to others, feel behind, and the fear of making the wrong moves keep us from making any move at all. But what if I told you that investing isn't a race? And it's certainly not about being the smartest person in the room. It's about understanding a few fundamental principles. Today, we are going to demystify investing by breaking down 7 essential rules that can transform your financial journey, turning that fear into confident action. Hello everyone and xin chào. I'm Yui, a Vietnamese dentist based in Singapore. On this channel, we choose intention over autopilot by sharing honest stories and lessons that help us build a life of true freedom. Let's grow together toward a life we truly love. Okay, as a dentist, I've seen firsthand that how many of us, especially in our early 30s, hit this quarter-life crisis where we are doing well professionally, but our personal finances feel a little chaotic. We've worked hard for our income, but the idea of making that money working for us feels like a foreign language. The world of investing seems shrouded in jargon and high-stake gambles, making it incredibly intimidating. I remember feeling exactly that way, frustrated, comparing my progress to others, and wondering if I ever truly get ahead. What I've learned is a profound perspective. Investing isn't about getting rich quickly or beating someone else. It's about becoming a better investor. And that journey starts with understanding the basics. So let's dive into these 7 foundational rules that can change your entire approach. The very first rule, and perhaps the most crucial, is always knowing what kind of income that you are working for. Most people only ever focus on one type, and it is the hardest one to build wealth with. There are 3 main types of income. First, ordinary earned income. This is your paycheck, your salary, the money that you get from your job or direct labor. It's the most common and unfortunately, it's also the highest taxed. When we're telling our kids to get a good job, we're essentially telling them to work for this type of income. It's essential for security, but it's a tough road to true wealth if it's your only focus. 2. Portfolio income. This comes from paper assets like stocks, bonds, and mutual funds. It's popular because these assets are generally easier to manage. Think of it as your money making more money through the growth and dividends of companies that you own a tiny piece of. 3. Passive income. This is primarily derived from real estate, but can also come from royalties or licensing. The beauty of passive income, especially in real estate, lies in its significant tax advantages. It's money that flows into your pocket without trading your time for it. While many advocate for working hard for earned income, the path to true wealth often involves working hard for portfolio income and passive income. The distinction is vital. You need earned income to live, but you need portfolio and passive income to truly build wealth and achieve financial freedom. So ask yourself what kind of income that you are primarily working for. Once you understand the different type of income, the second basic rules become clear. Convert ordinary earned income into portfolio or passive income as efficiently as possible. Imagine a simple funnel. At the top, you pour in your hard-earned salary. The goal isn't to keep it all there, but to channel as much of it as you can into streams that generate portfolio or passive income. This is the core mechanic of investing. It's not about complex algorithms or insider trading. It's about systematically taking the money you earn from your job and putting it to work for you in assets that generate more money. Now, I know what you're thinking. But how? How do I get the money if I don't already have it? What if I lose it? Those are valid questions, and we will touch on the how in future discussions. For now, the crucial takeaways is the what. The fundamental purpose of an investor is to make this conversion happen. Don't let the fear of how paralyzing you from understanding the what. Risk is always part of life and investing, but negativities and fear often bakes us out of opportunities. Start with understanding this basic conversion. Rule number 3, securities are not necessarily assets. This rule often trips people up. Keep your ordinary earned income secure by purchasing a security that you hope to convert your earned income into portfolio or passive income. Secure in a security, you may ask. What about assets and liabilities? This is where we expand our financial vocabulary. Most people confuse a security with an asset. A security is simply an instrument you buy, hoping it will keep your money secure and generate a return. It's a piece of paper or a digital entry, a stock, a bond, a piece of real estate. These are securities. An asset, by definition, is something that puts money into your pocket. It generates income. A liability is something that takes your money out of your bucket. It generates expenses. The critical distinction is that the security may or may not be an asset. You may buy a stock that raises in value and pays dividend, making it an asset. But the same stock could drop in value and cost you money, making it a liability. The confusion and the risk often begins when investors assume that just because they've bought a security, it's automatically an asset. It's our jobs as the investors to discern which securities are true assets and which could become liabilities. Building on the last point, the fourth rule is perhaps the most profound. It is the investor who is really the asset or the liability. You often hear people say investing is risky, but I've learned that it's the investor who is risky. Think about it. You may have seen perfectly good businesses go bust, and profitable real estate turn into a money pit, all because of the person at the helm. Conversely, a skilled investor can take a struggling asset and turn it to a gold mine. A good investor isn't afraid of risky investments. They're looking for opportunities where others have failed. They are like a repairman, looking at a wreck and seeing if it can be fixed. They don't just buy something because no one else wants it, but they look for situations where a liability can be transformed into an asset. This is why you often find the best bargain where others are crying about their losses. It's not about following the crowd when everyone's making quick money. It's about having the insight and skill to see the value where others see only despair. The true asset in any investment is you and your financial intelligence. The fifth rule is a powerful antidote to anxiety. A true investor is prepared for whatever happens. A non-investor tries to predict what and when things will happen. How many times have you heard someone say, I could have bought that land for a fraction of the price 20 years ago, or I'm waiting for the market to crash before I invest. These are the voice of predictors, not preparers. Opportunities, especially the truly lucrative ones, often appear in narrow windows. If you are not prepared with education, experience, and available cash, that window will close before you can act. Being prepared means training your brains to know what to look for. It's like a soccer player who practices constantly. When that winning kick at the goal appears, they are in their positions and ready. Predicting the market crashes or trying to time the perfect entry point is the fool's game. It's driven by fear and often leads to inactions or bad decisions. A prepared investor, in the other hand, is ready to profit whether the markets go up or down. They understand that the market falls faster than it rises, creating immense opportunities for those who are ready to act. Don't predict yourself out of opportunities. Prepare yourself into them. Rule number 6. Money finds good deals and good investors. This rule addresses a common concern. If you are prepared, meaning you have education and experience, and you find a good deal, the money will find you or you will find the money. Many people hesitate to invest because they feel they don't have enough capital. But I've learned that truly good deals, one that promise great rewards, attract cash. It's like a magnet. The challenge isn't the money. It's finding the deal and being the right person to execute. Think of the world-class race car. No one would bet on it with an average driver. In investing, whether it's real estate, business, or paper assets, the key is always people, people, people. You may have seen prime real estate in the best location lose money because the wrong people were in charge. Investors are looking for competent people for solid opportunities. This SEC exists to protect unsophisticated investors from bad deals, but your best protection is your own preparations and the ability to identify and manage a good deal. Finally, the 7th basic rule is the ability to evaluate risk and reward. This is where you start moving beyond basic security and comfort into the realm of rich-level investing. Let's say you have your foundational plans in place and you have some excess cash, money you can truly afford to lose without impacting your basic needs. Now, how do you access a more speculative opportunity? Consider this. Your uncle wants XX thousands of dollars for a hamburger stand. Emotionally, you may want to help. Financially, High risk, low reward. The most important thing isn't just the return on investment, but the return of investment, getting your initial capital back securely. But what if that uncle has 20 years of experience as a VP at the major burger chain, and for X thousands of dollars, you could own 5% of his new, potentially global company? Now, the risk is still high, but the reward potential has increased dramatically with the same amount of capital. This is the essence of evaluating risk and reward. For the high-level investment, the 3 E's are emphasized. First, education. A deep understanding of specific investment, market, and economic forces at play. Second, experience. Hands-on knowledge, a track record, and wisdom gained from past successes and failures. 3. Excess cash. Not just extra cash, but money you can generally afford to lose and still profit from learning or even take advantages from that loss. If an investment can't be explained simply, if someone uses jargon and makes it sound complex, it's often a red flag. As I have learned, if someone can't explain the investment to you in less than 5 minutes in a way that allows you to understand it, then either you don't understand, he doesn't understand, or both of you don't understand. Keep it simple, sweetheart. Why investing is always easy? It should be understandable. So there you have it, 7 fundamental rules that form the bedrock of intelligent investing. This isn't about becoming millionaire overnight. It's about building a strong financial foundation, understanding the game, and continuously improving your skills as an investor. Investing is a lifelong learning journey. It may seem complex at first, but the more you grasp the basics, the simpler it becomes. The more money you make and the less risk you face. The biggest challenge for most people isn't the market. It's investing the time in their own financial education and experience. Don't let the fear of unknown hold you back. Start by internalizing the rules. Begin to see your earned income as the fuel of your investment engine. Distinguish between securities and true assets. Understand that you are the critical factors in your financial success. Prepare, don't predict. Trust that good deals attract money, and always evaluate risk against reward with a clear, educated mind. Which of these rules resonated with you most today? Let me know in the comment below. And I'll see you in the next video. Peace.